Good afternoon, all. In today's class, we are going to see about analysis of financial performance and positions through ratio analysis. Through ratio analysis, how a financial position of a company can be analyzed. That we will see in detail. Before that, we will see what is ratios. A ratio is a simple arithmetic expression of relationship between one number to another number. That is how far one number is dependent on the another number. So the relationship between two similar magnitudes, how the one number is dependent on the other number, or how far there is a relationship between each number is expressed in the ratios. So with respect to the different number, how many times the number is dependent on the others, or how many times the first number contains the second. So ratio of 5 to 2, or it is written as 5:2 or 5/2. It is the proportional relation. So it is nothing but a simple arithmetic expression. So we will see the meaning and definition. The ratio analysis is a technique of analysis and interpretation. It is a arithmetic expression. The numbers are expressed, it is in the numerical term, and it establishes the relationship of one financial item with the other financial item. The relationships are expressed in terms of the ratios. So it shows the proportional relationship. So now we will see about the definition. Ratio is an expression of a quantitative relationship between two numbers, because we are seeing about the quantitative analysis. So it is the expression of quantitative relationship between two numbers. This definition is given by Wixon, Kell and Bedford. Now we will see about the uses of ratio analysis. Ratio analysis helps in decision making. With the result of the ratio analysis, we can make important decision in the with the company's analysis. We can write the report. It helps in forecasting for the future and take important decisions and plan accordingly for the future. And it helps in communicating and coordination. So information of financial statements and better, it helps to communicate in a better manner. That is, the result will help us to communicate in a better manner. And what are the different areas where there is a lack of any there is delay, or there is a lag, it will help to overcome all those things. And it helps in profitability positions. So it helps in fundamental analysis for stock investment also. The important measures like EPS, dividend payout ratio, etc. can be measured with the help of the ratio analysis. And it helps in credit evaluation by the financial institution. And it also helps in audit and taxation purposes. Now we will see about the limitations of ratio analysis. So the main limitation disadvantage is lack of adequate standard. Based on the information which is there, we are applying a formula and we are finding out the result. So there is a lack of standard adequate information, and it requires expert or trained professional. Unless otherwise I know how to implement or how to apply that, it will be difficult for me to apply the ratio analysis. So it is a difficulty in that. Interpretation of ratios are individual centric. Individual centric means from that particular source of the data only we can take the decision. And possibility of window dressing. Window dressing, that is, you can manipulate the results a little bit. So there are possibilities subjected to personal bias based on the knowledge and experience. If I have a little knowledge in that and I'm applying that without having a complete understanding of it, in that case that can be a mistake. So these are the limitations of ratio analysis. These are the classifications of ratio analysis. That is, it is classified based on the traditional classification, functional classifications, and significance classifications. And again, it is subdivided into balance sheet ratio, profitability, profit and loss account ratio, and composite ratio. Under that, under balance sheet ratio, there are so many ratios which we will see in detail. And profit and loss account ratio also, gross profit ratio. There are so many ratios that under each divisions we will see the ratios in detail. So traditional classification, it is also called as a statement ratio and based on source of information. So these are the functional classification of ratios, that is liquidity ratio, leverage ratio, activity ratio, and profitability ratio. So these are the different ratios in detail we will see. Liquidity ratio indicates the short-term solvency, ability to fulfill the obligations. Example is current ratio. Leverage ratio helps to indicate the long-term solvency. That is, example is debt equity ratio. Activity ratio, it shows the efficiency of usage of resources, also known as turnover ratio. Example is inventory turnover ratio. So profitability ratio indicates overall performance, that is gross profit ratio. So these are the categories of ratio we saw. Under activities of ratio, activity ratio, we are going to see about stock turnover ratio, debtors turnover ratio, and creditors turnover ratio. So all these things we have discussed earlier. So these are the things which we are going to see in detail. And under each ratio, we will be working out some of the problems. Thank you. And if you have any doubt, you can ask.